Trideep sir is having almost 2 decades of experience in equities, both in Indian markets and global markets. So, can we start,
Sure.
Trideep sir?
Thank you very much for inviting me to MINTIT. Look forward to.
It's our pleasure, sir. So before starting some questions, I just wanted to know about your journey throughout this 20 years into this investment industry, and how has been you have experienced an investment behavior or investors behavior into this.
So I think I'm still a student of finance and student of markets. Even though my experience in markets, both India and globally put together, would be close to about 25 years. Half in India, half abroad. The first decade of my investing went in terms of company analysis. The following decade and a half, actually, where it was more oriented towards investing, and that's when I got a flavor of behavior of investors, both retail as well as institutional, and not only domestic but also overseas. I think one of the things that I can certainly say is the maxim of greed and fear truly works in markets. I have seen markets overreacting both on the upside and on the downside over the last 25 years many times, and that's what makes this job interesting.
So in the past, we have seen many multi-bagger years. What is your view on investing in markets for next 5 to 10 years from here? Basically, after COVID, we have seen a very good rally in four years, and the investors' behavior change a lot towards they are chasing returns. But for next 5 to 10 years, what you are suggesting, sir?
Yeah. So people generally talk about this being India's decade. I actually did a study looking at where India is in its evolution journey and compared India's evolution with what countries like Japan, South Korea, and Taiwan went through during their transition from an emerging markets to a developed markets in the last 100 years. What I found is that there comes a time in the life cycle of a country where the GDP per capita rises multifold. For example, in Japan, it happened between 1950 to 1980, where the GDP per capita went up about 14 times. Now, that was their time of moving from an emerging market country to that of a developed market country. But what is interesting is during this time, the equity markets went almost 60 times over that period of time, right? And I could go on and on, but a similar sort of a data pattern can be seen in Taiwan and South Korea as well. In that context, if you look at India, since 2014, under the similar leadership and similar principles, we have broadly seen GDP per capita actually double or a little higher than that. And our equity markets are roughly about two and a half, somewhere between 2 to 3 times over that time frame. Now, while clearly the markets have gone up to X, but if you put it in the context of what some of the other countries have gone through when their decade were there, we are just about starting the journey. So, with this study and example, I would say that the next 5 to 10 years, in the context of India, are the times if we continue to get the policy continuity in the right direction, then I think we have a great decade ahead of equity market returns as we have seen in Japan, South Korea, and Taiwan.
Great. Okay. We all are hearing about India's growth story from every corner. How this growth story will change financial journey of investor?
I think the equities culture in India is just about waking up. If you look at historical investing patterns of an average Indian, I would probably argue it is more skewed towards real estate and gold. However, since COVID, that is changing. And but having said that, still equity as a proportion of an average Indian would not be more than 10%. I see that in the next 10 years, next 15 years, this proportion rising to almost 10 to 15%. And in that journey, I would say that it will be a very fruitful journey for an average investor simply because the benefit of compounding.
Correct.
Now, if earnings compound at roughly about 15%, which is what it has been happening over the last 15, 17 years, then 1 lakh rupee invested is more than 8 lakhs over a period of 10, 15 years at the horizon that you're quoting about. And that has got to be a positive way of looking at equity markets. The only wind or caution in the wind that I would throw is this return is not linear. So there could be ups and downs, but if the investor stays intact, then I think returns over a long period of time, like a decade or so, would be very high for an average retail investor.
My next question and that answer coming from you is very important, sir. What do you suggest to investors about the importance of risk profiling and goal-based investing?
This is probably the most important question in the list of questions that you sent across. I must say that the first thing that an investor should do when he thinks about investing is to sit with an advisor who understand profiling of the risk of the investor himself, and in that context understand what goals he wants to achieve in his life. Once you have the goal, which is the target return, and the risk that the investor is willing to take, only then the advisor can advise on the right asset allocation and the mix of the same, which is the first and the most important step that the investor needs to go through. Once that is set, then which choices within that asset remains to be decided. That's an easier decision to make. But I think the first step that I would advise through your very popular, media is that the first step of goal-based investing, of having a clear goal and understanding the risk profiling in that context, is very important for investor to start his investing journey.
Thank you so much, sir, for this answer. And so basically, people should stop random investing and they should give a goal or a milestone to their investments. Correct.
Along with the risk profiling.
Along with the risk profiling. Uh, so my next question is, what mistakes one should avoid in wealth creation journey?
And I would probably answer this question by giving an example that the historical asset allocation of an average Indian is heavily skewed towards real estate. Now, once you buy a plot of land or a flat, you don't see the price of that real estate next day or the day after because it's not listed anywhere. You only broadly come to know about the price, how it is doing by prices that's happening in that area. And that soothes the nerve of an investor. But when it comes to equity investing, because the share prices are listed in stock markets and the markets are is a emotional maniac, it keeps going up or down. You get to know the value of your holding every day. Now that makes some investors nervous, and in that short-term nervousness, some investors can forget about the long-term wealth creation goals like we discussed earlier, or the wealth creation journey that this particular investment guy gives through. So in many ways what I'm trying to say is sometimes, given the volatile reaction of the markets, investors tend to kind of react to short-term gyrations of the market, ignoring the long-term wealth creation journey. And that, in my opinion, is the biggest mistake that an investor makes and should avoid.
Right.
So, in a nutshell, one should focus on time in the market rather than trying to time the market and act based on short-term gyrations in the market.
Correct. In most of my videos, there's this single quote is coming that time in the market is important and not timing the market.
True.
Right. So moving towards the next question, sir. Your thoughts on current market valuations and what would you suggest for long-term investors?
Right. So I think the first step in the journey of a long-term investor, as I highlighted, is setting the right goals, setting the risk profile, and setting the asset allocation right. Um, and then one looks at within various assets, one of the assets being that of equities. Within equities, when I talk about market valuations in that context, I would subdivide this question into two parts: large caps and mid and small caps. I think large cap valuations are actually quite attractive. Yeah, slightly lesser than 10-year average. and I think good to invest. The mid and small cap valuations are trading at a premium of 15 to 35% versus their 10-year average. But that is only half the story. The other half of the story is the fact that the earnings growth of mid and small caps are meaningfully higher than that of the large caps. So, in many ways, I would advise the long term investor to not to avoid mid and small caps, but to have a mix of large, mid, and small caps in the equity part of their portfolio. Okay. So that kind of results in a certain choice of funds, which could be, a flexi cap or a multi cap fund or a mid cap fund, which has different combination of large, mid, and small caps. That I leave it to the advisor and the investor. But that mix is very important to have a mix of large, mid, and small cap in one fund, because when the valuations kind of swing around, the fund manager can make the decision basis attractiveness which part of the market cap he wants to operate out of. And that flexibility in the current market is very important.
Correct. Uh, my next question is, sir, do you think every single investment, be it long term or short term, need risk profiling? And you have answered it. Uh, Even short term investment needs a risk profiling. Correct.
Yes, indeed. And I think, any investment needs risk profiling, because first, and you might find that when you sit with an investor, he may not be aware his own risk profile. Only when an experienced advisor sits with him and rational or speaks to him about behavioral side of investing, both it's a process of discovery between the advisor and the investor, the risk profile of that investor, and basis which the short-term component and the long-term component should be evaluated. So if you ask me, the starting point is risk profiling, and basis the decision on the risk profile, you decide on how much should be short-term, how much should be long-term, to what extent one could say short-term risk, and things like that.
So my next question is, sir, based on your experience on investments or your personal investments, uh, what do you suggest to the new investors or the investors those who are in the market to create a wealth?
So the first thing that I would suggest is from my mistakes and from successes, that these are the few principles that come out, which I think is gold standard for an investor to think about investing. And the first thing that I would say is start early. I didn't start early. I was late in understanding the benefits of compounding. um, the benefits of compounding multiply is probably the eighth wonder of the world. And to understand that, one needs to realize that the longer one stays in the market, the longer the compounding works. So if you start early, then clearly the benefits of compounding one can enjoy a lot over a period of his or her career, which I'm sure will span multiple decades. Second, I think I talked about earlier that time in the market is far important than timing the market. And I was in a meeting with a distributor where he was saying that his best wealth creation that he has done for a customer is the one who forgot that they had a certain amount of money invested in equities and only looked at 20 years after she had put the initial quantum amount, and that had the highest kegel amongst all the rest who kept switching around in every 2 years to achieve the wealth creation. So the best wealth creation is achieved if we can spend as long as a period of time in the market rather than trying to switch around basis short term advice. That's the second advice I would sort of give. Third, I would say that get an experienced advisor. Um, you know, um, Mahabharat, which is one of the epics that we all follow, was won by Pandavas, even though they had the lesser manpower, because they had the right advisor, with the name of Lord Krishna. So, someone who can guide, who can understand the risk profile of the investor and make the investment choices along with the investor in an informed way. For them, having an experienced advisor is basically key in this investing journey, which lasts over a period of time. And finally, I would say that get the asset allocation right. Asset allocation doesn't mean that you invest only in equities or in debt or in gold. One has to have a mix of all of the assets in the portfolio. What proportion one should mix it is something that investors should decide in along with that of the investor, along with the advisor, rather than listening to maybe the financial channels or the multiple sporadic advice that one gets. So those would be a few principles which I would encourage investors to keep in mind as they embark on their investing journey, and hope through your media I can influence some and wish them a very successful journey over a period of time.
Great. So my just last question on the just latest updates, since you are having a very good experience in international markets also. So when it is coming to a Trump winning, what impact we will get on U.S. markets or in Indian markets of that?
So I think Trump and his policies truly are an enigma. And clearly, they have kept a close guard with regards to what they want to talk about, because it will have implications for not only emerging markets but developed markets and also United States. But from what we read and understand, two or three things are fairly clear. That over the next couple of years, we will probably have a stronger dollar regime. And when I'm saying a stronger dollar regime, I mean a stronger dollar as a currency versus the other currencies in the world. So that will have its implications with regards to which assets and which asset classes do well. It will be generally negative for flows for emerging markets, but within that flow, overall, given the strong domestic story of India, it might be better. But the overall context would be probably a bit of a headwind rather than tailwind. So that's one, a stronger dollar regime. Second, I think we probably know that we will, across the globe, have higher tariffs of goods being shipped into United States. That is probably a negative for global trade. And generally, what we have seen is when that results, when that happens, it results into tariffs and counter tariffs, and it's basically non-productive from a capitalism standpoint. However, the silver lining in that is that India's positioning amongst the various countries is and more as an ally to United States than otherwise. So I would imagine that the incidence of tariffs in India would be relatively lesser, though we might see some impact, maybe less than others, but still there will be some impact coming through. And the third, I would say that given that he's talking about higher fiscal spending for US corporates, the health of US corporates might actually stand to do better. The US economy kind of stands to be better. And given that one of the important trading partners of India is United States, overall I would say that the trade value would actually stand to go up. So if I put all of these together, I would say that you know from a business standpoint, probably India would stand in a far better stead than our North Asian and South Asian neighbors under Trump regime than what we have been earlier. The final point that I would make in this is, I would expect under the Trump regime um, lesser geopolitical trouble as compared to previous 5 years under Biden regime. So look forward to some peaceful times, hopefully better trade for India as a trade partner with that of United States, though that might be punctuated with a bit of tariffs.
Great. Well, thank you so much for such insightful session, and I hope our viewers will enjoy this video. Thanks a lot
Thank you.
once again.